Well, hello everyone. Welcome back. Welcome to Two Accountants, One Gap, where two accountants try to go here and figure out how to decipher gap accounting. Um, I'm back here with my co-host Bacon, and today we're going to be covering the most interesting things like balance sheets that everyone just loves when it comes to investing or if it comes to running a business. um, Fuhat, we are on time. Don't you
There
don't
is a
you
bit
dare
of a lag.
slander us.
There is a bit of a lag, but yeah,
Okay.
I have YouTube in another tab, and we're going.
And so what we're going to do today is just kind of go through, I'm going to call it a shallow dive because if you really want to do a deep dive, like an accountant type thing, yeah, we're not, I don't know if we'd ever cover it that in depth. But what we want to do is kind of cover for the person who's beginning, the person that hasn't, um, really gotten to look at or gotten a class or taught fundamentals of financials, the statements, what they mean. And we're going to start with balance sheets.
Yeah.
So what I'm going to do is kind of piggybacking off of last week. We're going to pull up Google's balance sheet from their 10K and just go from there. So what I'm going to do is share my screen, and I will let Bacon lead us
Uh-oh.
off. I know this might be, kind of repeating, but tell me a little about balance sheet. Like what very high level overview. What is a balance sheet? What's the purpose of it?
All right. So to a bit of a repeat, but it is the snapshot or moment of time of what a company owns and owes, and what's left over at that specific given moment in time. Being a day.
Hmm.
So my hat kind of gives it away. It's the accounting equation. We have A being assets. There we go. I can point properly, which equal liabilities, what the company owes, and plus equity.
Hmm.
People tend to sometimes forget. Oh well, my assets don't equal my liabilities. What's going on? Well, equity is what's remainder. You can have negative shareholders' equity as far as what's left over. It has happened, and currently, some publicly traded companies show that. But generally speaking, though, that's what it is. Now, what it all means is, like for a company owner, or like if you're looking to buy shares or stock in a company, you you own that company, yes, but at the same time, what does own mean? And the very nature of common stock is you have a residual claim. So the E part is again just what's left over after you take what you own, the
Hmm.
assets, subtract out the liabilities. It's not a clean one to one because some companies are definitely worth more alive than dead. So
Yeah.
that value of that equity is it's one that people can debate over, but from a purely like residual standpoint of what's owned, what's owed, what's left over,
Right.
that's what the balance sheet will try to capture.
Perfect. And so to summarize then, assets is what's owned,
Yes.
liabilities is what's owed, and
Yes.
equity is the difference between the two.
Yes.
Okay.
Yep.
And obviously you want your equity to be positive. There's a
I
lot
do.
of cases where it can be negative. I mean,
Yes.
one of the things I think about is tons, I would imagine, of like VC companies will have negative stockholders equity. Um, there could be a decent amount of like nonprofits off the top of my head would be one,
Hmm.
things like that. But generally, you want it to be positive.
Yes.
Even in those two fields, you want it to be positive if you can.
Yep.
Oh, we're competing with Chemers. Oh
Still,
man.
yeah. They were
Well,
talking about golf last I heard, but
the thing is, we're not at the statement of cash flow. So depending on if you think a balance sheet or cash flow is more important, you can decide where to go.
yeah.
Uh, but so moving then to assets,
Yeah. A little bit more
tell me
granular.
about assets. Tell me about how the balance sheet is set up. So I see it's an order of assets, liabilities, stockholders' equity.
Hmm.
If we go to assets, how are they? There's a. I'm asking a leading question. I know
Yes,
there
yes, because
is a method to how these assets are listed, and what is that exactly?
Yeah. So we have durational nature of it. Current assets, long-term assets. Same thing with liabilities. Current liabilities, uh, long-term liabilities, long-term
Mhm,
debt. Some of the words are like are really worth sticking points, but others
mhm,
and not as much. But within current assets, so the way how gap accounting is supposed to work is
mhm,
you have it listed by liquidity. So cash liquidity being like how how quickly, how easily is it for you to turn it into cash? So cash is already cash. You
right.
can turn it into cash, like it's there. Another asset though, such as I don't know, like maybe a company owns a factory. That
Mhm,
yeah, maybe you can turn a factory into cash, but it's going to take a little bit longer. So
mhm,
there's nuance there. So like in the case of Google here, we have cash and cash equivalents. What are
mhm.
equivalents? Generally speaking, some people would say like T-bill type, you know, but depends.
But I would imagine
That being marketable
Google's
securities.
listing. Google's got to be listing it here as marketable.
Yeah, that's what I assume as well in this case.
Which, for the
Yeah.
record, so well, go ahead because I think I know the actual technical term for
Mhm.
the difference between the two.
Yeah.
I think it's, correct me if I'm wrong, and you probably remember this because you're tighter to the academic, but I think if it's a T bill, and this is like getting really technical, doesn't really matter, but like just a T bill that has a, I think it's duration of less than 90 days from when you
Yeah.
bought it
Yeah, I want to say that
is
it
a, it's
certainly is that. Yeah, that is the
it's
sticking point.
it's either 90 or 120 days. But either way,
Yeah.
what happens is basically what companies do. Well, I'll let you explain it. What companies do with their cash, and how they buy different. And if you want me to, I can explain. But they buy different CDs or treasuries, and
Yes.
how that's done.
Yeah. Yeah, that
So,
you took the words right out of the
yeah,
explanation right there.
right.
Yeah,
So,
if you're Google or some proper company, you got all this cash. Are you just going to let it sit in a checking account, a company checking account or multiple? Maybe, maybe not, and odds are probably not considering how much cash we're talking.
mhm,
So you might as well have a little bit of extra juice from the squeeze, hence cash equivalents, hence marketable securities,
yeah.
uh, which like Gap neatly lays out: total cash equivalents, and marketable securities.
Mhm,
Uh, Accounts receivable. Some people might say, "Well, what the heck is this?" Not every company settles their transactions in cash right away. So if you're Andrew Corp, you're running Andrew Corp, and I supply you pencils. We've been in business for
mhm.
quite some time. Am I going to be a stickler and be like, Andrew Corp, pay me today? Like, no, that's like the worst customer service ever. Like generally
Right.
speaking, we're talking what, like a 30-day pay me in full type thing. Andrew's gonna mute himself because Doggo's going nuts.
Remember, there's always three. I forget to remind people there's three members of this team. It's me,
Yes.
Bacon, and Tilly, my dog. So she'll be here in the background also.
Yep. So that's accounts receivable. Now, some people may look and see a comma in the word net. The heck does that mean? Well, there's an accounting nuance and the principle of doubtful accounts.
Oh.
Yeah, so we're a doubtful account, which is what's called a contra asset. We
Mhm,
have our accounts receivable, something that we should be expecting. So in my case of pencils to Andrew Corp, I'd be like,
mhm.
I have accounts receivable. Maybe your money good for it, but maybe Viewer Corp. See, I'm getting people in. Viewer Corp, maybe a little shaky. Maybe like eh. So generally speaking, accountants and finance teams
Mhm,
will already have like an allowance for this, an allowance for doubtful accounts. They'll set it and reduce accounts receivable,
mhm.
and hopefully they're wrong or they're right, and it's
Right.
perfect. Uh, Not always, but
Yeah.
other current assets for some companies that'd be like inventory.
Mhm.
Um, Something that they're expected to sell within the time frame in question. Um,
Yeah. And one of the things I just wanted to add that's interesting, and you bring up a really good point. I was going to get to the net portion, but you brought that up, and I was like, excellent point.
yes.
So one of the things basically, if you want to think like just to kind of think, because I'm the one at my organization who sets what our rule is for doubtful accounts or how we do our accruals on it.
Hmm.
So basically, how it works is someone in the accounting department gets says this is what's going to be our policy at X number of like we're going to have some kind of rule that determines how we are going to try to say what accounts are uncollectible.
Yes.
So generally, what happens if you think through this logically is let's say you invoice Andrew Corp.
Hmm.
And most of the time, people they will send you an invoice that it's called net 30, which means pay us back within 30 days. But Andrew Corp hasn't paid you in 120 days. Andrew Corp has some cash flow problems because Andrew Corp was invested in YieldMax and it finally ran out. But no, but so they have some cash flow problems. So generally, it's usually not company specific. Usually, so like at my company, the way that I set it up was we have different depending on which bucket it's in.
Hmm.
So if we don't put anything to bad debt if it's within 0 to 30 days, for example.
Yeah.
Even 31 to 60, I still don't put anything to bad debt. Once it gets over that, I have different amounts that we expense it at or write it off at.
Yep.
So that's the net thing. And is it entirely well, there has been one time where the accounts receivable made us get out of a company that I think has underperformed quite significantly. Well, I don't know if it's significantly, but it's underperformed since then.
Mm.
That you know about in terms of investing in the public markets.
Yeah.
But will it be helpful ever? Maybe, maybe not. But it's just something that's good to know, I suppose.
Yes. Yeah.
So, sorry to interrupt, but keep.
Oh,
keep on going.
no, it's all good. Yeah, and footnotes should be helpful in letting you
Mhm.
know what their method of allowance for doubtful accounts or bad debt expenses,
Right.
what days or what ranges get triggered. It is important to note that accounts receivable is one of those things that can be a little screwy with some companies and may be worth really zeroing in on focus with, because like the other current assets we talked about, inventory.
Hmm.
uh I mean, some cases inventory is relatively simple. What's that?
Do you want to do like a real quick? We can do like a quick deep dive on AR.
Yeah, sure, why
I'm
not?
thinking of the one example that we had. If
Yes.
we can pull it up. Do you want to pull it up? Here, let's
uh
pull it up.
yeah, I say so. I'd
Okay.
say so. Yeah.
So this was something that we used to kind of help us look at a company that looked like they were doing really well. Revenue was growing, net income was growing, everything looked good. And actually, in some of the community saw it, and like I looked at it, I wasn't invested in it, but I thought, oh, it looks interesting. And it all looked good until someone asked me, hey, what's up with the accounts receivable?
Hmm.
And so I'm going to pull this. It's called HireQuest. So they're a small company.
Yep.
And well, we can walk. So when you bill someone an invoice and it goes on accounts receivable, right? So if you go back, when do you recognize revenue in this process? When you're sending the pencils to Andrew Corp, when do you
Yeah.
recognize revenue?
So for this case, it's relatively straightforward, being physical good.
Right.
It's when you, Andrew Corp, have the pencils in hand. I mean, yes,
Mhm,
there's FOB shipping, like where the shipping point is
mhm.
pre-agreed upon. But outside of that nuance, so it's very, very clear revenue recognition.
Right.
Once that obligation has been met, then you recognize.
Right. And one of the um, so basically, you send me an invoice and you recognize revenue at that point.
Yep.
And if we go back to what you're saying, I'm going to go back and look at Google.
Yep.
Whoops, go down.
Yep. A
It
little bit
moved on me.
more.
That's odd.
There we go.
Okay, maybe I had two Google. I had two 10Ks open. I was looking at something else, I guess.
It's all
But
good.
we were saying this is done in order of liquidity and the expectation of how quickly we turn this into cash, right?
Yes.
So looking at this, the assumption is we will turn accounts receivable into cash pretty quickly.
Yes.
Like it's a pretty liquid, it turns into cash quickly. Generally, it's 30 days, it sounds like normally to get
Generally
cash.
speaking, yeah. Yeah.
Well, you have this company here. And first, if you look at the income statement, which is where a lot of people start, nothing wrong with that.
Mhm.
This is a company, you know, even on a net income basis, looks like they're at, you know, looks like they're heading for like 10 million in net income. I don't remember. I think they were like a 200, 300 million market cap company. So not massive, but
Mhm.
not small. So they're saying, okay, we have 6 million revenue.
Yeah.
But
But
but look at this.
yeah.
If you, I mean, so 9 months ended. I mean, I could do the annual, but you're saying you have roughly, 30 million. We'll say like 35 to 40. Let's say 40 million. We'll be generous and say 40 million in annual income, right?
Mhm.
Well, you have 40 million annual income, but that asset, the accounts receivable that's supposed to be extremely, extremely quickly turning into cash, you have more than 1 year's worth of revenue here. So it's like, hold up.
Yes.
And this is net.
Mhm.
And so you're like, wait a minute, what's going on here? And I will say, generally, when you're looking at smaller companies, it's good to know these things just so you can kind of um, understand, you can kind of catch red flags because
Yep.
it's not always as, Google, it's going to all be above board. All those things. But with these companies, sometimes things can get a little funky, um, and so you look here and they break down their allowance for doubtful accounts and how they do this.
Yep.
Um, and they basically say everyone pays within 42 and 84 days for the most part.
Yes.
Well, that doesn't make sense.
We have a
Something's not adding up here.
periodicity discount. Yeah, disconnect. Yeah.
And so, uh, and they eventually say somewhere, basically, if any, they basically say, I'm not going to read through everything in here. Essentially, what they say is, we don't write off any AR. None of accounts receivable is written off by us.
Yep.
We don't write off anything. And so you're like, wait a minute. So, this is a bit of a deep dive, but if you go, and we'll eventually cover the cash flow statement, but if you go to the cash flow statement, you realize that their net income is almost entirely being propped up by accounts receivable this year.
Mhm.
So you're like, wait a minute. So, anyways, point is, accounts receivable is, in theory, very liquid,
Yes.
and usually it is.
Yes. Generally speaking.
It
But
should, but it's a good thing to know how it works and why that net of allowance and understanding how the company does its allowance is very important. And I think that's an
yes.
excellent point that you're bringing up here.
Yes. Yeah.
The free thinkers have yet to recover from HQI.
Oof.
I don't think it was pretty quick that people saw this and got out and it was like relatively.
Yeah, I want to say so because,
Mhm,
like, behind the scenes for viewers, we're in a community that likes to research publicly traded companies,
mhm.
and that one was one of those things where it's like, yeah, we're in the middle of the research process. Like, no one's necessarily saying buy or sell or short sell or whatever. Just, yeah, we're interested. We're looking.
Yeah. And for
Um,
anyone that's wondering, when he says the community, we're assuming everyone here is from Capital Mindset. But if you're not,
yeah.
there's a community on YouTube called Capital Mindset. We're part of it, and we look at
Yes.
public equities.
Um, so yeah. Back to
So that's
current
accounts
assets.
receivable.
Yeah. Other types of current assets would be, generally speaking, inventory. I'm butchering the order here, but inventory, notes receivable, bonds receivable, um, or a current portion of bonds. Different sort of assets where you're expecting, you know,
Mhm.
some sort of future cash flow from something or some sort of future revenue. Um, yeah,
Yeah.
yeah, yeah,
Yeah, I
and
mean, it could be something like, this is whenever you see other,
Hmm.
Think of it like not core to the business.
Yeah.
Maybe it wouldn't. Google's probably the other way, but imagine like Google sued someone, and that person owes Google. This is 10 billion, $3 billion.
Oh yeah.
Well, they're not going to make like a separate. They're just going to put that in other probably.
Yeah. Yeah. Materiality matters.
Imagine 3 billion being immaterial. That long neck.
Yes. Uh, and again, thankfully, Gap breaks it out to total current assets. Now, why are these things broken up into different subcategories? It helps the investor out a whole lot as far as thinking in terms of part and whole, as far as what about liquidity and what about solvency being
Mhm,
long-term health of the company, which is a nice pivot for longer-term assets.
mhm.
Uh,
Nice. Well done.
yep. So we have, in this case, non-marketable securities. So different securities that aren't publicly listed that Google owns in this case. Uh,
Do you, there's one company that Google owns that's a non-marketable security that people talk about sometimes.
oh, I'm drawing a blank.
SpaceX.
Oh, space. Oh, yeah, yeah, yeah,
Their,
yeah.
their share of SpaceX would be in there.
Yeah, yep. Deferred income tax. So the companies through tax accounting sometimes do have deferred benefits parked right there, as we can
Mhm,
see. Uh, Property and equipment net, much like accounts receivable, we have a contra asset here that counteracts, so to speak, the
mhm.
property, plant, and equipment. That would be in the form, in this case, of depreciation, non-cash expense, but it is an expense that needs to be recognized and appreciated and counteract what we have for our property and equipment. Our property and equipment, in this case, fundamentally, you buy something, be it a whole bunch of computers, an entire building. The world's not perfect. Things are going to degrade over time. Now, how you account for depreciation matters. Some companies are beautiful and straightforward. They go with a simple, simple straight line depreciation. Others go with a double declining balance. I want to say was that. There's a fair amount of other nuances with
Um, are you
depreciation.
saying the depreciation on operating lease assets?
Just depreciation in general for property for PP&E, property plant.
Oh,
Yeah.
because they just ASC 606 was it? No, 606 is revenue. Is it 841? But either way,
Yeah.
it's a cry. Um, I can't remember because it used to be straight line, and I can't remember how they changed that. No, because my company still does straight line, so I
Yeah.
think you can still do it that way. But either way, there's different, and we can get into that at some point. There's different
Yeah. Yeah.
ways
Yeah.
that companies calculate how you depreciate things, and
Yep.
it's and
Footnotes.
what and probably a lot of the deferred income taxes that we're talking about comes because there's different rules on how you depreciate for taxes versus how you
Yes.
depreciate for
Yep.
GAAP accounting for
Mhm.
your income statement.
Yep.
And so those differences in how you're recognizing depreciation, for example, or other things can cause a discrepancy in how much you owe in taxes versus
Yep.
how much income you say you have. And so that's how you get that as an asset.
Yep.
But
And I also, to double back on inventory, completely sidestepped FIFO, LIFO, and average unit or dollar cost. Yeah. So, but I figure again that can be
Mhm.
done in bigger detail in the future. Anyways, operating lease assets, relatively straightforward. You have a right to use asset, being a lease in this case. Um, it's an asset. Some for From an academic perspective, uh, students will often see what's called a prepaid expense. Prepaid insurance. If you've already shelled out money for insurance for a 6-month period, you've only gone through 1 month. You still have future months paid for, so it is an asset, albeit not a very liquid one, probably. Goodwill is the fun one. I'm
Goodwill
not a big
is
fan. Yeah, not a big fan.
we could do a whole thing on goodwill.
Yeah, yeah. Did you want to light it up?
So, do we want to get into this? So, what goodwill is um, goodwill is what you would call a plug.
Yeah.
So there's a reason that like, and we'll get into why you can impair goodwill. Can we show companies with the largest goodwill impairments? I don't. Who would that be? I have a question from Malaka,
Hmm.
but
There might be some, maybe somewhat like one of the larger healthcare players.
mm,
Maybe.
I know there's probably been someone that wrote off a ton of goodwill,
Yeah.
but we'll find them. We'll look up and we'll find them. But so basically, how goodwill works is, let's say Andrew Co. is kind of struggling, but Bacon Incorporated sees a lot of value in Andrew Co. And so Bacon Co. says, well, what we're going to do is we're going to go out and we're going to buy Andrew Co.
Yep.
Andrew Co., it's a terribly run business. It's, we're going to overpay for it, but we think the synergies are there and all of that. So, and honestly, and actually, we're going to switch this example because we're going to say Andrew Co.'s operating well, but Bacon Incorporated wants to buy it.
Yep.
And Bacon Incorporated says, yeah, Andrew Co., like, not only are going to have synergies with us, but they're performing well, their revenues, their cash flows are going well, so we're going to buy them.
Yeah.
Well, let's say you go out and you buy Andrew Co. for $4 billion, and we become a part of the Bacon conglomerate. And so what happens is you look at our balance sheet.
Yep.
And our balance sheet, we have $2 billion in assets and $1 billion in liabilities, but you paid $4 billion for us. So in accounting, you have to be able to match two separate things. So you have to be able to match, it's called debits and credits. You always hear like accountants like debits have to equal credits.
Mm-hmm.
Well, basically you're crediting $4 billion in cash, but you're only getting $1 billion in assets from Andrew Co. And accounting doesn't like have like future cash flows as like some thing. What accounting says is you're paying an extra $3 billion for this. We're assuming you see some value in it. So we're going to put that as an asset and put it on your balance sheet. But besides that, we don't really know what to do with it. So we're just going to leave it there unless Andrew Co. underperforms.
Yep.
So in this hypothetical example, and you can see Goodwill wrote off a tiny bit of, or Google wrote off a tiny bit of goodwill.
Mm-hmm.
No, it didn't. It bought someone. It had gained a little bit of goodwill. Sorry.
Yeah. 22 to 23.
But let's just say, as an example, you buy Andrew Co. And then once you start getting in there, you realize, man, it is just like a crap show. We thought that they were running really well, but they're actually not. And we don't think that actually we're going to get the value we thought we would get from Andrew Co. And so what you do is you test your goodwill and say, actually, we don't think Andrew Co. is worth $4 billion. We now say they're worth $3 billion. So you basically go in and you expense and you impair the goodwill that you paid for Andrew Co. So that's like a quick thing on goodwill. It's more of a plug for when you're doing acquisitions.
Yep.
So you're acquiring companies, you're paying over and almost every time a company gets acquired, you're going to have goodwill because no one goes out and buys a company just for the assets minus the liabilities.
Yeah.
There's always a cash flow.
Yeah.
What percent, and Alaka just said, what percentage of the time does an acquisition not show up on goodwill? Almost never.
Almost never.
There's one example I know of.
Mm-hmm.
It's Shutterstock when they bought.
Oh yeah. Yep.
They bought
Giphy, I think.
Giphy for less than their assets.
Yes.
So Shutterstock got Giphy, and the reason that they were able to buy them. Oh, sorry, I accidentally turned on but the reason that they were able to buy them for so cheap was the EU basically told Meta, who had acquired Giphy, you have to divest from these guys, and you have like X amount of time to do so.
Mm-hmm.
And so Meta just basically dumped them and
Yep.
said, okay, they got like, was it like $50 million? I think,
It
and a
was
lot, yeah,
metaphorically pennies on the dollar, so to
yeah.
speak.
So, and Alakazam wasn't it blocked? I think they did the acquisition, and then afterwards the EU said you have to sell it.
Yep.
I can't remember. But anyways, so that's like one of the few times I've seen it not show up on Goodwill. And actually, how do you, in that case, there is a, you still have, you still have to book it's, I think it's a gain on acquisition at that
Yeah.
point.
Yeah.
Yeah. So
I
like
want to say so as
super
well.
rare. If you see like gain on acquisition, you're like,
Mhm.
whoa, like they got some distressed asset.
Yep.
You know, so
Uh,
that's kind of how that works. But
now there. Oh, go ahead.
I was gonna say, but almost always you're gonna see it on Goodwill.
Yep. Now there is one like other nuance though, and some
Mhm,
people have asked about this. Uh, People might look at, say, the case of Bed Bath and Beyond having gone bankrupt.
mhm,
Uh, in the process of Bed Bath and Beyond going bankrupt, some companies bought bits and pieces of them. That does not necessarily go into goodwill because in the case of the artist formerly known as Overstock, I
mhm,
think their ticker symbol is now BYON or something like that.
mhm,
Uh, they specifically bought just Bed Bath and Beyond's like intellectual property, customer list, some other like
mm,
intangible things. And because they only bought a specific part of a company, you didn't see goodwill like increase at all in Beyond's or formerly Overstock's, you know, goodwill
right.
or balance sheet.
So
Uh,
basically, so they said we're buying this, and we're saying the cash we're paying for it is exactly the value. Is
Yeah,
that?
pretty
Oh,
much. Like, yeah,
I
so
didn't know
like
that.
their intangibles went up, which you naturally would expect. Something has to go up if you're buying something. Uh, and in this case, obviously not goodwill because didn't
Mhm,
buy the whole company. They just bought very, very specific part of it, which
mhm,
again, intangible assets. So there we go. Like I know a fair amount of people have asked about that as far as like, well, you buy this company, is it all goodwill or is it like divvied up into bits and pieces, like
yeah.
a bought out company, you throw the property, plant, and equipment into new property, plant, and equipment. It's like, no. Um, so yeah, goodwill. I guess maybe in the future we can double back if
We
comment
could
section
we
and
can probably
audience
at some
demands.
point
But
get down into like the actual impairment entry because there's a whole
yeah,
thing we have to test for impairment,
yes,
which I always find funny because it's like, how do you do that?
hmm
And the other thing too is goodwill never increases from like it's not like you'll ever look at a good something like you paid 4 billion for a company. You're never going to go back and say, well, actually, what we paid for that company was they were worth 50 billion, so we're going to increase goodwill,
yeah,
anything like that.
yeah,
Goodwill, it's there to help reconcile the accounting numbers at the end of the day.
yes,
I
yeah,
mean, you can make some argument that there's some like functional purpose for it, but I think mostly it's a plug.
yeah, more or less, yeah, I'd say so.
Um, the scary thing is when goodwill starts to get written off because then oh
Yes.
shoot.
Then you got to call into question the management team and their decision
Right.
making and all that. So yeah, other non-current assets. We're talking broadly speaking, the under the intangible bucket. I want to say things
Hmm.
like copyrights, patents, things
Hmm.
with longer term uh, intellectual property, what have you.
Right. I would imagine, yeah, because this doesn't have they don't have intangible assets anywhere.
No,
I would imagine things like because they've probably trademarked or put some kind of dollar. I imagine they went and trademarked the Google
hmm
um like logo,
yeah,
things like that.
yeah,
Or, yeah, there's a bunch of little intangible things. That's why they kind of like I said, whenever you have other, it's fairly immaterial. It's just a
hmm
bunch of little different things and they put them together.
yeah. And to oversimplify, intangible, obviously. Yes, technically a patent, you can there's a legal document, you can touch it, but it's more
Mhm.
like the concept behind the patent rather than like you can touch inventory, you can touch cash, you can touch property, plant, and equipment. Whereas, intangible assets, it's more conceptual based. But yeah, that rounds out total assets.
Mhm.
So depending on on the person in question, people like to take a look at things with either just current assets, just cash, or total assets, and they'll compare that to liabilities and
Mhm.
take a look at the health of the company. Um,
Right. No, I want
so,
to say.
mhm,
Well, actually, I'll say this after we go through liabilities.
yeah.
Um, so go ahead and explain liabilities, and we'll start with
Okay.
current.
So, yes, just repeating again, liabilities, what's owed. So, just like how we had current assets as far as a time component, we have current liabilities, also time component. So, accounts payable, in the example of, me selling Andrew Corp pencils, though, me giving you those pencils would be Andrew Corp's accounts payable.
Mhm.
Let's see here.
Yes.
Accrued compensation and benefits. Uh, that's just what, like, generally speaking, labor related, or rather probably management related, but as far as size and scale. Uh, yeah, accrued expenses and other current liabilities. Uh,
I I think when you look at this, it's really
yeah,
interesting.
yep,
One of the things I see is like how good of a business model Google is to have like okay, 5 or 7, we'll say 7.5 billion sounds like a lot of
yeah,
accounts payable.
yep.
When you take into the fact that like they have 110 cash billion of cash, they spit out something like, and by the way, current usually just means expect to be paid within a year.
Yeah.
And so accounts payable, and this is also generally, I think, it's listed in the order of like, and it wouldn't be liquidity, it'd be how quickly I have to pay this.
It's what I want to say.
Because like accounts payable,
Hmm.
this basically means you've already expensed something and you're like basically lining it up to cut the check and send it.
Yeah.
Um, accrued compensation and benefits, Bacon could take vacation tomorrow
Oh yeah, yeah,
or
yeah.
leave
That's a good
tomorrow.
example. Good example. Yeah.
And
Paid vacation, paid time off. Yeah.
or just like I quit, pay me out my PTO. I mean,
Yeah.
um, and then then you have accrued expenses. Well, generally, I'm accruing my utilities expense if
Hmm.
my um, not at the current company, but the previous one I worked at.
Yep.
One of the entries I had to do was accrue expenses for
Hmm.
all of our 500 locations for utilities and these other things. Like basically, you run a trend analysis and say like, this is what they should be paying in utilities every month. This one
Yeah.
missed because maybe a company, you know, the utility company normally bills me on the 30th of the month, but it's February,
Yep.
so I don't get billed until March or something. And so that's or it just took time for the store to get it to corporate. And so then we'd accrue it.
Yep.
Um, oh, and then we have my favorite
Revenue share or accrued revenue
liabilities is well, because revenue share is that's the revenue share that they're paying out to YouTubers.
It's what I want to
Or
say.
okay,
Like, as an example, I mean, can't all be just that, but
because I don't know when it's saying revenue share, I'm assuming that's YouTuber payments, but maybe not. I don't know.
mm,
Um, every company is going to have like slightly different things. Like accounts payable is pretty standard. Accrued revenue share, you probably want to look at the footnotes to see maybe they break that out.
yeah.
But no, Bacon, you want to talk about my favorite liability account that's right below accrued revenue share?
No, deferred revenue.
Yeah. So do you want to like explain just briefly what that is?
It's
This is
not a liability because it has a revenue in the name. Good sir.
exactly. No,
I
it's
joke. I
well,
joke.
the liability comes because I have to earn the revenue.
Yes. Yes.
But
Yes. So it's a case of my suspicion, and I haven't really dove that deep into Google
mhm,
in any recent time, but like, say for example, you own a stadium of some sort or like a sports arena.
Hmm.
Uh, people pay for tickets for an event in the future, but you haven't done anything to to earn that money yet. So it's deferred revenue. Another example would be anything subscription based. Google happens to have a fair amount of subscription offerings.
Hmm.
I mean, yes, odds are they're gonna execute the service and recognize that revenue, but they already got paid for it, and you can't speed time up any faster to give them, their Q2,
Right.
part of the subscription right now. Like, yeah,
No, that's such a really good point. I bet you that is like YouTube subscriptions or YouTube TV.
I wouldn't be surprised. Yeah, that if I had to guess, I don't know, but that's my guess.
Yeah, because the thought behind this is, and the reason I'll explain why it's my favorite liability, but the thought is, if I pay you for something,
Yes.
in theory, if you don't give me that service, you have to give
Hmm.
me that money back.
Yes.
So if I pay you for YouTube Premium, and then Google wakes up the next day and goes, "I'm shutting down Google." Well, you owe me back because I paid for a month membership, so you owe me
Hmm.
back the 29 days that I didn't get to. If I used it for one day, you don't get you owe me back the 29 days that I didn't get to listen to YouTube. The reason it's my favorite liability is because it's not, you never actually have a cash payment that you have to do against it usually.
Yeah.
It's more of what generally happens is the way you get rid of the deferred revenue is by recognizing revenue. And so
Mhm.
that actually, instead of turning into money out, turns into revenue,
Yeah.
which is why it's my favorite.
Yep. In which case, all this neatly sums up current liabilities. Other
Hmm.
examples would be, notes payable, what have you, or current portion of a debt payable, some
Hmm.
sort of debt instrument. Uh, Now, the funny thing is that, like, from a finance perspective, you take a look at working capital, which would be the components of current assets and current liabilities.
Hmm.
And this is why a lot of people happen to like more tech related companies is, well, you get cash, like, sooner rather than your expenses being pushed back a little bit later. But there is a give and take. Like the more traditional businesses, like you build widgets, sell widgets, what have you. Generally speaking, it's the inverse. But if you discontinue a business line, then generally speaking, then it works in the favor of the traditional business model. Whereas something more tech and subscription based, it's just a trade off. That's really
Right.
all it is. Yes, there's a discounted method that needs to be appreciated, but
Hmm.
just a trade off, just different business structures. Anyways, long
Well,
term debt. Oh God,
you hit on actually something interesting. I'd like you to flesh it out just a little bit,
yeah, yeah,
because
yeah.
I hear people talk about working capital sometimes.
Yes.
Pretend I don't know what working capital is. Explain it to me and why. Because you hear, and well, we can talk about the companies. I hear a lot from construction companies for one,
Hmm.
but what is working capital and why is it something that's significant?
So working capital, from, like, again, just my own basic, like,
Hmm.
finance understand or attempt at understanding is current assets and current liabilities as far as any
Hmm.
sort of company or project. So in the case of a construction company, they want to take on a project. Well, you don't get to start a project without throwing money into what you need to do. You got
Right.
to move equipment around, got to move bodies around. That costs money. So it's money up front now. Whereas, like with the tech company, yeah, you probably have some R&D and some other things, but if you got your product ready, you could start getting subscription revenue much quicker and much earlier, and rather than, like, having to be like that construction company or an industrial where
Mhm.
you got to throw all this money to build this thing up first,
Right.
and then like start turning out money. And as you wind things down with a traditional company, maybe you sell the factory, you sell some land. uh, that's why that working capital goes in favor of the traditional company once that product line is discontinued, in theory.
Right.
Whereas more of a software company, you don't have that much to spin down.
Hmm.
So once the thing's discontinued, you're probably not getting all that much, if anything, out of it once it's done. That's it, again, it's just a trade-off. And yes, you're supposed to apply discount rate, but
Well, it's a trade-off, but you made an excellent point that a lot of people like
mhm,
software companies sometimes because they're asset light.
Yes.
And working capital is great because
Yeah.
if we think about it, if I am, we're going to say a construction company, right?
Yeah.
I get a contract.
Yeah.
Awesome. It's a 2-year contract. Awesome. And you're seeing this a lot with like infrastructure companies,
Mhm.
builders, things like this. That's great that I got this contract. But before I see $1 of the contract, I have to go out and I have to buy or rent construction equipment. I have to go
Yeah.
out and potentially front some of the cost of materials.
Yes.
I have to start paying things. Maybe if it's an out of state job, I'm starting to pay for transportation and housing for my employees to do the project. Um, and so working capital comes into play because it's kind of saying, and what's really important is looking at the change in working capital and kind of
Yes.
reconciling that
Yes.
to your revenue cycle.
Hmm.
Um, and so I know a lot of people hear that sometimes. It's just like, what is working capital? And you'll hear like I said, if you ever listen to earnings call for a lot of these construction companies, things like that, maybe someone will be like, "Hey, you guys have a lot of revenue, but your cash flow is really poor this quarter. What's going on?" They'll be like, "Oh, our working capital is just like it comes and goes in waves or something,"
Yeah.
and that's usually what they're talking about.
Yes.
Company like Google, they don't have
Yeah.
any of those problems. It's
Yeah.
like we get paid and we get the cash instantly. So
Yep.
that's kind of the difference there.
Yeah. I figured it was a nice little conceptual thing to throw in
Hmm.
with deferred revenue and total current liabilities.
It's an excellent point.
Yeah. Long-term debt. Again, just bonds. Generally speaking, it's bonds or some sort of notes
Hmm.
payable, what have you. And in Google's debt, or in Google's case, they don't break, or at least for this one, they don't break out like bonds payable. But uh, once a bond comes due and is up for maturity, for the current liabilities, you'll see current portion of long-term debt, what have
Hmm.
you, which would signify, hey, a whole bunch of debt is either gonna come due, gonna mature. We can we can safely put that out of mind, or maybe they refinance, what have you. Whole bunch of other details to consider. Um,
Yeah, and it's a really important thing, not for Google, but to pay attention to the long-term debt of companies, the
yes.
current portion, and when that long-term debt becomes due.
Yeah.
Um, Generally, a company, I almost don't need to say generally, but I'm going to say generally companies, because maybe Apple's the one I think exception to this.
Mhm.
Generally, companies don't get like fixed rate 30-year loans as their debt. I think Apple issued some like bonds at like 1% or something ridiculous
Yeah.
that came due in like 2050, and yeah, they're never gonna call those early.
Yep.
But it is important when you're analyzing some companies, depending on the industry, depending on what company you're looking at, how much debt do they have?
Hmm.
When does that debt come due? Because that can be risks for the company.
Oh yeah, certainly.
But Google is not one of them.
Oh shoot, there was one other thing though that I wanted to bring up. Um, I'm drawing a blank for whatever reason. Oh, other types of long-term debt. I'm not seeing lease obligations, which is a bit of an accounting nuance because IFRS doesn't allow people to capitalize leases.
Hmm.
In the past, I want to say long-term leases were just thrown in with long-term debt. That's what I want to
Yes.
say. Yeah,
And
which
you said IFRS. Did you mean GAAP?
Gap has
Yeah.
allowed the two to be separated, whereas
Right. Right.
IFRS is like, no, screw you, it's still long-term debt.
Yes.
Uh, did you want to touch on that one at all, or no?
I hate how IFRS does leases. Do I want to get into because I'm currently invested in a company that has long-term leases, and even I have someone because I spent a long time trying to convert those numbers to GAAP because it's easier to parse through GAAP data, and the company will be reporting GAAP soon.
Hmm.
But I have someone who professionally works on converting IFRS to GAAP, and he even told me for this particular company, he's like, dude, it's a pain in the butt doing their conversion, like their financials. So, um, but basically, uh, we'll focus on GAAP for now. We can do an
Okay,
IFRS.
all good,
Uh,
all good.
yeah.
I mean, the reason, like, as I understand it, and feel free to yell at me if I'm wrong, but the reason why it's separated is because, like, a bond payable, bond payable, relatively straightforward.
Hmm.
Pay interest, pay principal, whatever, however it's structured. Whereas for capital lease or for lease, it's a right to use asset. Yes,
Hmm.
you need to pay for it, but you still have a right to use component. There's a element of an asset to it, which goes up as operating lease
Right.
in that case. But um, that's my understanding as far as like arguing why the two, like why it's not in just long term debt, but
Hmm.
um,
And
conceptually, anyways.
well, and I think for analyzing a company,
Yeah.
breaking them out is useful
Yep.
because they're two fundamentally different things.
Hmm.
Long-term debt, like a bond, it's just debt that I have to pay off at some point that should be coming down. I am making interest and principal payments, or maybe it's an interest payment that has a 5-year balloon. Who
Yep.
knows? With an operating lease liability, basically what that generally is it's rent. And I'm going to pay that rent, and that rent is going to remain relatively fixed, and we're just going to go from there. And so I feel like if you're analyzing a company, it's useful to have those two broken out because if you put all that into long-term debt, I'm going to appear a lot more levered than I actually am.
Hmm.
Like I have more debt than I actually do.
Yep.
So I think what you do is when you parse those and break those out, you get a clearer financial picture.
Yeah.
But
Alrighty.
that is.
Hmm.
Then you have
Okay.
total liabilities.
Total liabilities. Yep.
And then, and you can see here, and we can go through this junk, but we're running close to an hour, so maybe I'll say is, but you can see assets,
Yep.
liabilities equals stockholders' equity. And that's why you'll always see this total liabilities and stockholders' equity
Yep.
equals your assets.
Yep.
Um,
If it doesn't, your balance sheet does not balance. Something has gone very wrong.
I have seen many balance sheets that don't balance. It can happen. Don't worry.
Yep.
But
But yeah, stockholders' equity.
Mhm.
This is where you'll see preferreds, different classes of commons, and thankfully Google is an example that has multiple classes. Woof.
Yo.
Uh, the funny thing is that like for people that are like want to read through everything and like be really really exact and precise, uh, some people might say,
Hey.
some people might see par value and be like, "What the heck is this?" This is a convention from way back when, of back what like the late 1800s for the U.S. side of things, early 1900s roughly, where
Mhm.
like share price would be at a par value, and you're supposed to be able to buy it at issuance with a little bit extra, which would be called additional paid in capital. That being said, though, there like even way back when, like if you bought a bankrupt railroad company, your par value wasn't worth anything. So don't worry too much about par value. It's something for
I,
accountants to worry about.
yeah, the par value on this stuff and the APIC and everything,
Yep.
we'll probably cover it at some point. I
Oh
think
yeah,
for
yeah, yeah.
now, the basic thing to know is like
Yeah.
stockholders' equity is just
What's
the
left over?
cumulative value of what the business has.
Yeah.
Like the in theory, if I was the owner and I owned 100% of Google outright,
Hmm.
I could just say, you know what? I'm closing business down. I'm going to liquidate all my assets, sell my liabilities. I'm going to get $283 billion.
Yeah.
That, I mean, and at the end of the day, also, it's like another thing that's not really super relevant because when we're looking at a business, I don't think we value businesses based on that.
No,
Now,
no. By and large, generally speaking, no.
there are times where people sometimes would, like historical value investors, the Ben Grahams of the world,
Hmm.
they would look at it because remember, think about nowadays the amount of access to data we have is so much more.
Yep.
But back then, I'm gonna catch this. Back then, you had to like drive up probably to the New York Stock Exchange, ask for the financial statements. Who even knows the financial statements, like how accurate they were? And so what he would do is he'd look, and there was plenty of companies like this where he would look, and maybe the company was trading at $10 a share.
Yep.
If you looked at the book value of the assets, like the assets minus the liabilities, it was $15 a share. And so he could just go in there and be like, I'm going to take a big stake, liquidate the company.
Yep.
Like sell it, liquidate it, and pay me out. And that was like, so back then, I mean, there was some value to that. When you see a company's trading that cheap, you generally don't see that nowadays.
Yeah.
There's like fringe cases where it has happened. I think one of them was Wish. I don't know if they still are. Let me see. But there was like, because they're burning cash. So, but there was a bull thesis on Wish for a little bit saying if you just get them to sell everything, they're worth more dead than alive.
Ah,
Let me see if I can pull this up. But it was kind of interesting. So, like, if we go to Wish here, so let's just go to quarterly results and let's see if on the 10K. Actually, yeah, we'll go 10K. That's fine. So if we go down here, we go to financial statements, balance sheet.
Yep.
Yes. So here you can see total stockholders' equity is 217 million, right?
Yeah.
If you look, and I don't know at the time what Wish was trading at, but if you looked here, it was trading at like 135 million.
Yep.
And so this was a case where like literally the bull thesis was shut down the company and sell all its assets. What happened to the Wish? Did I delete it? Oops. Let me go back. I accidentally X'd out of it. No, this is it right here.
Yeah,
right
that's
here. Okay.
That's it.
Whoops. And if you look at the stuff they have, it's cash and cash equivalents, marketable securities. You know, most of it's very liquid.
Yep.
They're not a ton of PP&E, and so it's not like stuff like if you sold it,
Yeah,
like it would degrade in value. Yeah. And so the theory was, okay, like we can just, cut all this out, pay out, because like if you look at the company on a like net loss, they're just losing tons of money. Do they have a cash flow statement? Statement of cash flows, like their cash flows using operating activities is almost like 300 million. So it just doesn't happen very often because the problem is that you have to be an activist investor and you have to be someone that can throw your weight around.
Oh,
you actually go in there, buy them, have the patience to be like, okay, sell this out, etc. But so it can happen, but it's very rare nowadays.
Yes.
Anything else you wanted to add, Bacon? Words of wisdom?
I mean, I guess just to look around the corner, you thinking income statement next?
Income statement next.
Okay, because it's very cool because Google's balance sheet helps out with us peeking around the corner. Because if you scroll up to the equity part of the balance sheet a little bit more, there we go. We got accumulated other comprehensive income
or loss.
Or loss, yeah. Generally speaking, it's usually supposed to be a loss in many cases, but yeah, a lot of nuance there that helps separate intermediate from basic, accounting.
Oh, I know where you're going with this. Okay.
Yeah.
Yes,
So that's just like a little bit of a taste of like sometimes people might think, oh, this is just immediately factors into net income, which will naturally fit into EPS, earnings per share. Not necessarily.
Nope, not always.
Yeah. So that's what I wanted to add. Is just a little bit of a nice wrap up and a hint for
and a little tease.
Content. Yeah,
a little tease out there.
Yep.
Awesome.
Did you have anything that you wanted to add?
No, I think we covered everything. If anyone has any questions, leave them in the comments. If you're one of the people that's on, Discord with us, ping us and ask. Other than that, though, thanks everyone for joining, and we'll see you next week.
Yep. Thanks for having me on, Andrew. Bye, all.
See ya.